let's talk about what's needed to start to build out a story that the bottom or a low could be setting up. First thing is anytime you're trying to predict a low might be becoming established or starts to play out is first of all, you got to break into it. So are we weak going into it? What do we know? And everybody knows that the market obviously is going to sell off into a low that you're predicting. So the market does sell off down into here, and then it has another sell off of about 8-9 points from here where my cursor is down until it ends up being the low. But you can't just start taking shots and predicting the low. You want to see the story begin to fill out. First thing is some buyers appear. That's these green lines. In this case, they appear in the form of icebergs. All right. Another thing happens, and that is these hollow green bars right here are longs puking. And what I'll tell you about longs and longs puking is this. Follow me. Longs, when someone is long, they are now a seller to exit that long. That's not elementary, but it is the people who are with me. It's not elementary to people before they become with us. So if that's not debatable, and it's not, after you're long, you are a seller to exit that position, then it only makes sense that when longs puke, which is another word, puke for exit a losing position, it only makes sense that when longs puke and exit, there are less longs, correct? When there are less longs, going back to this equation, if there are less longs, there are less sellers in the market. And I don't know about you, but I heard somewhere that for price to go up, having less sellers is pretty important. So that's one dynamic. And you see it here in what we're able to establish as sell stops, sell market orders that originate as sell stops. And I could tell you from my experience that sell stops are mostly used to exit a losing position. And if you're exiting a losing position with a sell order, that position is a long. All right. It only makes sense. People get stopped out of longs as price breaks. All right. So now we have buyers appearing in the form of icebergs. We have a decent long puke, which is also shown on our longer time frame chart up here, which compares us to other big long puke moments. So it's important to say, well, how much or how many longs puked, and to compare it to some other puke moments in that session. All right. So now as we go along and we start to understand this story, you don't necessarily get long and just buy it, but right in here, you see this iceberg jump, and he says, I just gets anxious and he wants to buy it. You see this purple box get rejected, which means it's a sell market order and it jumps above it. All right. You get more longs that puke on this second attempt down. And then you get a long down bar with a long up bar. It's another important moment, in this case, a chart pattern that shows you that you probably got people that are pissed off and short. Why? Because we go down, we go down, we go down, and they're all excited. We're going to break out. We're going to break out. And then in the very next bar, it retraces the entire previous bar. You start to see our laser go from 194 to just 40. So that's these two numbers beginning to tighten up. Let me rewind it and show you that it doesn't go green to red. It does in here, but it doesn't down in here. But what it does do down there is tighten up, which means there are more people starting to sell it in kind of a breakout. You see how many more longs, 279 to shorts? All right, let me just play it and watch that number tighten up. You're going to see a jump, probably. There's a jump, another jump, bigger jump. You see it tighten up. So it tightens up, it jumps, rallies, jumps, rallies. So it's a prelude to the rally instead of just afterwards. So what you do and what you have here is it's certainly not getting wider. It's tightening up to a point where it does get more shorts than longs right there. And then you anticipate it's ready to do that based on the other information we ran through. And now you're building the right components in reading order flow to establish when a low might be a low, whether it's the low of the day, low of the regular trading session, or just a swing low. But the point is the market rallied pretty substantially from that moment. And even if it doesn't get you to pick the low to get long, maybe you're short and it allows you to cover the short in a better spot. So you don't let nice winners turn into break evens or even losers, because that sucks. So a better place to get out of a short, a better place to maybe open a long, and certainly a better place to, as you see green to red, to have a B to B moment, as we call it. In this case, the B stands for bearish to the other B, bullish, B to B, bearish to bullish, which the market's showing you sooner than most of the other people who are trying to read and trade this market, that it's transitioning from weak to strong, bearish to bullish. And it's important to understand how to read order flow, but the important pieces to pull out so that you react to this information instead of having to think about it. Instead of just using a location of, let's say, in this case, 24.25 is going to be support. Okay, great. But you think that line is just going to be so magical that you're going to make money consistently just playing a line as a price? You're just going to play on the railroad tracks hoping the train stops? Or are you going to read some information as the train approaches before you jump on the railroad tracks? Because you're not going to be consistent unless you're reading the real time at some moment in time. I don't care if you're a short, medium, or long time frame trader. You have to read the real time because you're going to be entering and exiting in the real time, no matter how long you hold on to a trade, no matter how many points you try to capture. You're always entering and exiting in real time. So you have to read the real time. What information are you looking at in real time? And it's other people's positions, or OPP. I said OPP, other people's positions, as a way to learn and follow the intent of an order. Is it opening a long? Is it closing a short? Is it opening a short, closing a long? Is it exiting? So it's like, if you're not able to read price through the lens of what other people are doing, then you're not able to read price. You're not going to be able to predict what you need to happen next for price to do what you think it's going to do. And I said this in our room today, if you're waiting for confirmation, do the opposite once you see it. So if you get confirmation something will work, like support worked twice, so that's my confirmation it's going to be support, do the opposite. Sell through the third time. Don't just buy third, fourth, fifth tests to a support level. The more confirmation you get, the less likely it's going to continue to work. You know, when you get your confirmation that you read the market well, when your statement's emailed to you at night, that's your confirmation that you read the market well. So don't look for confirmation. Qualify is different than confirmation. Confirmation is what others also could see. And then when you see it, most of the rest of the world sees it, you don't want to do what every idiot in the world does. So confirmation is a poor word. And when you see it, don't use it as a way to qualify your trade. Read the intent of other people. Stop worrying about what you think and start worrying about what other people are thinking.